Every day you use digital money. Tapping your card for a coffee, sending a friend money through an app, shopping online. It's fast, simple, and completely controlled by institutions we've trusted for centuries. Banks, credit card companies, and governments. They move the money, they keep the books, and ultimately, they hold the power. But what if our digital money wasn't controlled by any one of them? What if it were powered by a global network of computers, where you are the one in charge of your own funds? What if you could send value to anyone, anywhere in the world, with no middlemen needed to give their approval? This is the revolutionary idea at the heart of cryptocurrencies. And while you've likely heard of Bitcoin or Ethereum, especially with their wild price swings and headline-grabbing stories, the technology behind it all can feel overwhelmingly complex, almost like a myth. In this video, we're going to change that. We're going to demystify it. We'll skip the dense jargon and use simple explanations to explore the mysterious origins of crypto. It's a brilliant technology that makes it all possible, and what its rise could truly mean for the future of your money. Before we can appreciate why cryptocurrencies were invented, we have to look at the system they were designed to challenge. And that system can be described in one word: centralization. For our entire financial lives, we've placed our faith in trusted intermediaries. When you pay a friend, you aren't actually handing them digital dollars. You're just sending a message to your bank, asking them to reduce your balance and tell your friend's bank to increase theirs. The banks are the central record keepers. What they say goes. Most of the time, this system works. But it has its own set of built-in problems. For one, it can be slow. An international wire transfer can take days to finalize because it has to bounce between multiple banks, each with its own hours and procedures. It can also be expensive. Each of those middlemen takes a fee for their service, which can be especially punishing for payments that cross borders. It's also a closed system. Billions of people around the world are unbanked, shut out from basic financial services because they can't meet the requirements of traditional banks. This leaves them disconnected from a huge part of the global economy. And then there's the question of trust and control. You are trusting a central authority, a bank, a government, to manage the system responsibly, to not devalue the currency, and to always act in your best interest. This centralized power means your assets can be frozen, transactions can be censored, and the entire system can be vulnerable to a single point of failure, whether that's a technical glitch, a targeted hack, or political turmoil. It was in the shadow of the 2008 financial crisis, a moment when trust in these very institutions was shattered, that a radical new idea began to take shape. In late 2008, a paper appeared online, published by a person, or maybe a group of people under the pseudonym Satoshi Nakamoto, titled Bitcoin, a peer-to-peer electronic cash system. It laid out a solution to the problem of centralization, a new kind of digital money that could be sent directly between people, with no financial institution in the middle. This was Bitcoin, the world's first cryptocurrency. So, what is a cryptocurrency? At its core, it's a digital token secured by cryptography, which makes it nearly impossible to counterfeit or spend twice. You can think of it as digital cash. But unlike the money in your bank account, which is just an entry in a private ledger, cryptocurrencies exist on a shared public record book that anyone can inspect. This public record is the revolutionary invention at the heart of it all, the blockchain. Bitcoin was the genesis, but its creation opened the floodgates. Today, thousands of different cryptocurrencies, often called altcoins, exist. Many were designed to improve on Bitcoin's original design or to serve entirely new functions. But to understand any of them, you have to start with the engine that makes them run. That we know what cryptocurrency is, let's explore how it actually works. This is where many people get lost, but the core idea is more intuitive than you might think. Imagine a group of friends who often spot each other cash. Instead of one person trying to remember who owes what, they all agree to keep a shared notebook. Everyone gets their own copy. When Alice gives $10 to Bob, she announces it to the group. Everyone then pulls out their own notebook and makes the same entry. Alice paid Bob $10. That shared notebook is the blockchain. It's a distributed digital ledger. Distributed means everyone has a copy, so there's no single central authority. This makes the record incredibly resilient. You can't secretly erase a transaction because it would still exist in everyone else's copy. To change the record, You'd have to convince the majority of the group to alter their notebooks at the exact same time, a nearly impossible feat on a large network. That is the power of decentralization. So what about the block and chain parts? To keep things orderly, the friends decide to bundle transactions together onto a new page. Let's say every 10 transactions, they start a new page. This page is a block. Once the page is full, and everyone agrees the transactions on it are correct, they seal it. Here's the genius part. To make it secure, each new page is sealed with a unique, complex code that is mathematically linked to the page before it. This code, created through cryptography, acts like a digital seal. If anyone tried to go back and secretly change a transaction on an old page, it would break that page's seal. And since every new page's seal is linked to the previous one, changing one page would set off a chain reaction, breaking the seal on every single page that came after it. This creates an unchangeable chronological chain of blocks. Once a transaction is on the blockchain, it's there forever, transparent and verifiable by anyone. So how does this network agree on what's valid? Through something called a consensus mechanism. Bitcoin uses the most famous one called proof of work. This is where mining comes into play. Miners are powerful computers competing to solve an incredibly difficult math puzzle. The first one to find the solution gets to validate the latest block of transactions and add it to the chain. For all that work, which consumes a tremendous amount of electricity, they are rewarded with newly created Bitcoin. This process serves two purposes. It validates transactions, and it introduces new coins into the system. Because of the high energy cost of proof of work, other methods have appeared. The most popular alternative is proof of stake. Instead of raw computing power, participants in this system stake their own cryptocurrency as collateral for a chance to be chosen to validate transactions. If they play by the rules, they get a reward. If they try to cheat, they can lose their stake. This approach is far more energy efficient and is used by major networks like Ethereum. And how do you fit into this? Through a digital wallet and a set of cryptographic keys. Your wallet doesn't actually hold your coins, they always exist on the blockchain. What it holds are your keys. You get a public key, which works like a bank account number that you can share to receive money. And you get a private key, which is like your secret password or signature. It proves you own the funds and is used to authorize any transaction you make. This key is everything. If you lose it, you lose access to your money forever. For years, when people said crypto, they just meant Bitcoin. But Bitcoin was only the start. The universe of crypto truly expanded in 2015 with the launch of Ethereum. Ethereum's creators took the blockchain concept and asked a game-changing question. What if, instead of just tracking transactions, the blockchain could run computer programs? This led to the invention of smart contracts. Smart contract is just an agreement written in code that executes automatically. Think of a vending machine. You put in a coin, a form of cryptocurrency, and the machine is programmed to automatically give you your snack. There's no cashier needed to make it happen. Smart contracts apply that same logic to far more complex deals. They run on their own when specific conditions are met, removing the need for brokers, lawyers, or other intermediaries. This single innovation blew the doors wide open. Suddenly, developers could build entire applications that run on a blockchain. These are known as decentralized applications, or dApps. This sparked the birth of a new world called decentralized finance, or DeFi. DeFi is an attempt to rebuild the entire traditional financial system: lending, borrowing, trading, insurance on the blockchain, making it open to anyone with an internet connection. Smart contracts also powered the explosion of NFTs, or non-fungible tokens, unique digital certificates of ownership for things like art, music, or collectibles, all secured on the blockchain. Beyond Bitcoin and Ethereum, thousands of other altcoins have appeared, each trying to serve a specific purpose. Some aim to be faster and cheaper for everyday payments. Others focus on enhancing user privacy. And then there are stablecoins, a critical piece of the ecosystem. These are cryptocurrencies designed to hold a steady value by being pegged to a real-world asset. Like the US dollar, they act as a vital bridge between the volatile crypto world and traditional finance, allowing users to hold a digital asset without being exposed to massive price swings. We're covering a lot of ground, and if you're finding this exploration valuable, take a moment to hit that subscribe button. We're about to get into what this all means for you. The opportunities, the very real risks, and how this could shape the future of money. So, the technology is brilliant, but what does it all mean in the real world? The rise of cryptocurrency has created a landscape of incredible opportunity alongside extreme risk. Let's start with the opportunities. The most obvious is the potential for significant financial returns. The stories of early investors in Bitcoin and Ethereum making life-changing fortunes are legendary. The bull market of 2024 and 2025, which saw Bitcoin's price soar past $100,000, has brought that possibility back into the spotlight. Many now see crypto as a way to diversify a portfolio, and some view Bitcoin as digital gold, a safeguard against inflation in a shaky economic climate. Beyond investing, the greatest promise lies in disrupting traditional finance. By cutting out the middlemen, cryptocurrencies could make financial services, especially international payments, much cheaper and faster. They also offer the hope of greater financial inclusion, providing access to services like sending money or earning interest to anyone, regardless of whether they have a bank account. However, the risks are equally profound and must be understood. The biggest by far is extreme volatility. Crypto prices can swing wildly in a matter of hours, often driven by little more than hype, news headlines, or regulatory rumors. It's not unusual for an asset to lose a fifth of its value or more in a single day. You should never ever invest more than you are willing to lose completely. Regulatory uncertainty is another huge challenge. Governments worldwide are still figuring out how to handle cryptocurrencies. While some countries are embracing the technology, others have imposed strict bans. As of 2025, the United States has signaled a more crypto-friendly policy direction, which has helped fuel the market, but the global legal landscape remains a shifting and unpredictable patchwork that can dramatically affect prices. Then there are the security risks. While blockchain technology itself is incredibly secure, the places where you buy, sell, and store crypto like online exchanges and personal wallets are major targets for hackers. Unlike with a bank, if your crypto is stolen, it's usually gone for good, with no central authority to turn to for help. The space is also rife with fraud and scams designed to trick inexperienced users. Finally, there is a massive environmental concern, especially with proof-of-work currencies like Bitcoin. The global Bitcoin network consumes a staggering amount of energy comparable to the annual consumption of entire countries like Poland or Qatar. This creates a significant carbon footprint, as much of that energy still comes from fossil fuels. While the industry is actively exploring greener alternatives and more efficient technologies, the environmental impact remains one of its most serious and valid criticisms. So, where is all of this heading? As we move through 2025, the world of cryptocurrency is at a crossroads, evolving from a fringe hobby into a major force in the global economy. One of the biggest shifts is institutional adoption. For years, Wall Street dismissed crypto. Now major financial firms and corporations are moving into the space. The approval of Bitcoin ETFs has given mainstream investors an easy way to get exposure through their existing brokerage accounts. And some public companies are even adding Bitcoin to their balance sheets as a reserve asset. This flood of institutional money is adding a new layer of legitimacy and stability to the market. Regulation will continue to be a central theme. As the industry grows up, governments are moving to establish clearer rules around taxation, investor protection, and preventing money laundering. This will likely make the market safer, but it might also chip away at the unregulated, decentralized spirit that first defined crypto. We are also witnessing incredible innovation. Developers are racing to solve the biggest challenges: scalability, energy use, and making the technology easier for everyone to use. The lines are blurring between crypto and other fields, especially with the rise of AI-powered blockchain projects and the tokenization of real-world assets. One day, you might be able to own a fraction of a skyscraper or a famous work of art, represented as a digital token on a blockchain. The story of cryptocurrency is a story of powerful contrasts. It's about a revolutionary technology that could empower individuals and reshape finance. But it's also a world of dizzying volatility, regulatory battles, and serious real-world challenges. It's an ecosystem that has created astonishing wealth for some and devastating losses for others. This is not a magic bullet. It will not replace the entire financial system tomorrow. But the core ideas it represents, decentralization, transparency, and giving power back to the user, are incredibly potent. The underlying technology of the blockchain is already being adopted in fields far beyond finance. From supply chain and healthcare to voting systems, whether cryptocurrencies will become the foundation of a new global economy or simply remain a volatile, speculative asset is a question that will be answered in the years ahead. But one thing is for certain: the conversation about what money is and who controls it has been changed forever. Understanding this new world is no longer just for tech geeks or traders. It's essential for anyone who wants to understand the future of finance. If you want to continue this journey, check out our playlist on the biggest players in the crypto space, where we do deep dives into Bitcoin, Ethereum, and the future of DeFi. Thanks for watching.